Thanks, Sydney. Thank you so much for inviting us here. Hi, everybody. Thank you for joining us. My name is Georgia Quinn. I'm a securities attorney. I know you've seen a lot of them today. But don't hold it against me. I'm really a nice person. I also started a legal technology company about 3 years ago called iDisclose, and we automate the filing of legal documents with the SEC for small capital raises. So when doing a Regulation CF crowdfunding offering, you have to file a Form C with the SEC. So we have a system that's very similar to TurboTax, where you go online, you fill out a questionnaire about your company, and it creates the document, and from your desktop you can just file it immediately with the SEC. You don't have to go through a third-party service provider. And we do that now for Form C, for Form D, Form CAR, several other SEC filings. So what I'm here to talk to you about today, however, are the legal ramifications around Title III crowdfunding, which I don't think anybody is here to talk about, and ICOs. And I am going to bore you with Title III crowdfunding first, but I want you to remember that whenever we talk about Title III crowdfunding, Regulation CF, it's also called, this is very applicable to the ICO market. So in order to access unaccredited investors, we may start to see these ICOs utilize a Regulation CF or a Regulation A or another type of offering so that they're not simply going after accredited investors and that they can bring in this different pool of capital. But we're going to start talking about Title III crowdfunding. So just some of the legal considerations, and these are in no specific order. And really what I'd like to do is kind of run through the topics that I have, and then I'd like to open it up for questions and really have more of a dialogue, because I think that's a lot more fun and a lot more useful to the people who paid to be here. So one of the first things you need to consider, and this actually goes, when I speak, I'm going to speak as for both ICOs and for Regulation CF offerings, because first they could be one and the same, and also these are just important legal considerations. The first thing you need to think about really is the entity type. So what kind of company are you going to use to raise the funds? You are limited to certain types of entities when it comes to Regulation CF. So you can't use an SPV or otherwise known as a special purpose vehicle. A lot of times when you're conducting a raise with a lot of investors, you want to cabin them all into a special purpose vehicle so they become one line on the cap table of the company. You're not really allowed to do that in Regulation CF. People have come up with a lot of other creative solutions to get around that, voting trusts and things called safes. So there are alternatives, but that's just something to keep in mind, which then brings us to the security type. So what type of security are you actually issuing in the company? Are you selling stock? Are you issuing a note? Are you using a safe? Are you doing a rev share? All of these things have proven successful in regulation crowdfunding offerings. So it's really kind of a decision on the part of the company what best fits their business strategy and the type of company that they are and the life cycle that the company's in. For regulation crowdfunding, as you guys know, there's a cap on the amount of money that you can raise. It's $1 million in a 12-month period. So that obviously has to be a part of the equation. And as we're talking about these multi-million dollar ICOs, it kind of seems a little irrelevant, but it's always an option, and it might be nice to tack on $1 million worth of really loyal fans of your product. Another thing to think about is the potential for doing a side-by-side offering. So what we mean by that is when you're doing a regulation crowdfunding offering, you can simultaneously be doing a private placement or a Regulation D offering. So anytime you would get an accredited investor, you would put them in your Reg D bucket. You could raise an unlimited amount of money, and then you'd put your unaccredited investors in your Reg CF bucket, raise up to $1 million from those people. A lot of platforms are doing that and having great success. And again, just from a practical standpoint, the benefit of that would be you can still raise your unlimited amount of money, but you are also able to offer the experience and the opportunity for your customers, your fan base, your social media followers to feel like they're a part of your journey. One just side note that people, when conducting these offerings, forget is that in order to file documentation with the SEC, you have to file for their credentialing on what's called EDGAR, which is their filing system. And so these are just some little roadblocks that can come up. So just keep in mind that there are some procedural things that have to take place before you can launch an offering, file these documents. So some additional considerations, which I don't know if people have talked about this already today, but when you're launching an offering for Reg CF, you're not technically allowed to advertise, or at least, you know, it's not like a no holds barred kind of advertising that you can do. You have to think about, you know, one of two types of communications you want to make. One is a terms communication, which can list very specific things about the deal, like the amount of money that you're raising, the type of security you're offering, the minimum investment amount, and the deadline. And then there's the non-terms communication, which can go into in-depth detail about the business plan, the operations of the company, the team, and, you know, kind of the mission of the company. Other, you know, considerations to keep in mind are the additional disclosures that are required once you conduct a Regulation CF offering. So to the extent anything changes, materially changes in the business during the course of the offering, you have to amend your public filing with the SEC. You have to provide updates in the form of this Form CU once you close your offering to make sure that you inform the SEC of how much money you raised, or at least a rough estimate. Also, you have to conduct an annual filing after you've had a successful raise. And then, of course, your financial statements will have to be attached as exhibits to all of these, and they have to be GAAP compliant, and in most cases, they have to be reviewed by a public accountant. Okay, Title III platform considerations. So in order to conduct a crowdfunding offering, you have to go through an online platform that has to be registered with the SEC and FINRA. And so some things that platforms, you know, really should be keeping in mind, and issues that have come up, are the minimum amount that companies are raising. So the way crowdfunding works is you set a minimum amount of money that your company must raise. And if you don't hit that amount, then you don't keep any of the money, and your deal is unsuccessful. And so if you set a limit or a minimum of $100,000 and you raise $99,000 online by your closing date, and you haven't reached your threshold, you have to give all that money back, and, you know, it's not a successful deal. So as a solution to that, what a lot of companies do is they set a very low, artificially low threshold, something that will not sustain their business, something that will not allow them to execute on their business plan. So that's a problem. So, you know, that's one of the things that the platform is working to vet through and make sure doesn't happen. Other things platforms have to keep in mind is compensation. So the way that they can receive compensation is in the form of a percentage of the amount raised. They can also take a percentage of the security that is being offered. One thing they can't do is co-invest, and that's kind of a shame, because it would be nice if the platform could, in addition to listing the companies on, you know, their platform, be able to put some of their money where their mouth is and actually co-invest and share that risk and that burden with the investors that are coming in. And then there's the closing mechanics. So one thing we're seeing in the market, which is a little disheartening, is that as companies are closing successful deals, it's taking a very long time for the platforms to actually remit proceeds to the companies. It's taken an even longer time for the platforms to remit their investor information, which has a lot of implications, not the least of which is a tax concern, where those investors actually need their K-1s or other tax documents in order to properly file their taxes, and the issuers aren't able to provide those in a timely manner. So these are just some things to kind of keep your eye on as we move forward in this very new sort of industry. Okay, so ICOs, this is why you're all here, yay. Okay, we got that out of the way. I put some very rudimentary sort of definitions up, but I'm seeing that this crowd is like, you know what you're talking about. So we're just gonna blow past that, and we're gonna get to kind of some of the fundamental legal issues and regulatory concerns about these ICOs. So ICOs, we've been talking about them. We've been talking about, are they a security? Are they not? We talked about the Howey test a little bit. Everybody here familiar with the Howey test? Okay, that was like totally, okay, all right, that's good. I'm not gonna like go back to corporate law or securities law 101. So the issue, as you know it, is, actually, I'll just take a step back. And this is kind of what the ICO market has meant to me over the past 2 to 3 years. So when I first heard about this, I thought, oh, this is a bunch of people thinking they're very clever, that if I just call it a token and not a share, that I can go and offer this, raise money for my company in a completely unregulated way to non-accredited investors. And, aren't I a genius? I must be the first person to ever think of this. And so I was just waiting for the SEC to crack down and be like, sorry, folks, this is obviously a security. You must register or, find some sort of exemption. $3 billion later, it's still happening and nobody's doing anything about it. But actually, some people have, certain agencies are now providing guidance, and it's becoming more and more clear to everyone that indeed these are securities. Indeed, you must register or find an exemption. There's a lot of new clever ways out there to structure things so that at one point in time they are a security and then they become a commodity. But regardless, there's no free money, people. So then, we get into this question, well, is it a utility token or is it a security token? And of course, the hope is that if it's this utility token, it won't be deemed a security. One problem with that is it still might be deemed a commodity. It still might be deemed a currency. So, it's like you jump out of the frying pan into the fire. But, the basic concept of the utility token is that it's more like a product, something that is useful in the provision of services by the company, and the security is really something that is just tied to the ebb and flow and success and failure of that company. So something that would be based more on the profit and loss of the company versus the actual products that the company is offering or services that the product is providing. So as we've talked, I've heard people talk about, we know that the SEC gave us guidance and said that, this is really just going to be kind of a facts and circumstances decision that they're going to be making on a case-by-case scenario, and the securities laws and you should apply them. And basically they just said, look at the law. The law is the law. And we're like, thanks for all that help. But it is good that at least we know that, the SEC is watching this, that this isn't something that's falling, under the radar. And also, just generally, it is a security. I think probably the only definition more broad than the commodity would be a security. And then, of course, Cooley, a law firm, has put out their SAFT white paper. And that's what I referenced a moment ago, which is this type of security that they are proponing. And I'd love to get people's thoughts on this, and we can kind of have a discussion if anybody is interested. But this is a security that at one point in time, at issuance, is a security. And you must find an exemption or registration for it. And it's basically an investment contract to receive utility tokens at some point in the future. So at this stage, the company's just issuing these investment contracts. They haven't built anything. They don't have a network. They don't have infrastructure. They have an idea, and they have a team. And so they'll issue the white paper. They will conduct this offering. In Cooley's opinion, it is really only for accredited investors. Those investors will invest. The company will then use those proceeds, build out the network, build out the platform, create these tokens, and then at some point in the future exchange those investment contracts for these tokens, which will then be utility tokens and not securities. And then they will be freely tradable on exchanges, just as any product would. Again, Cooley makes an analogy that the tokens would be more like silver, which is a commodity and is regulated. So this is where, again, we find one loophole or one, set of regulation that we're getting out of, and we just end up jumping right into another. So it's not, it's not going to be easy. But I do think it's great that people are being creative and coming up with different types of instruments and just, different thoughts. But so anyway, once it's converted into that token, it can then be freely exchangeable, and it is not a security according to this white paper, and can then just be bought and sold by anyone. And furthermore, the company can then issue more of those tokens at that time, and that would not be considered the issuance of securities. It would be considered the sale of a product. Okay, so just some other legal considerations that have been kind of flying around. So when I talk to people about doing an ICO, they have a lot of questions about the entity and should I start a Cayman company or a Swiss company or a Seychelles company or, and I think people have this idea that if you form some sort of foreign entity or something that's regulated in a different jurisdiction, that the U.S. securities laws won't apply to you, or that, U.S. laws in general won't apply to you. But anytime you're targeting U.S. citizens for their money, for their attention, for their data, U.S. laws are going to apply. So, you may just be adding more complexity to your whole organization and infrastructure by trying to set up these sort of offshore entities, and it may be best to just kind of do it plain and simple Delaware C Corp. Also, a lot of people are interested in forming foundations. A lot of times they think for tax purposes, but truly like that, what they think they're getting around isn't really what's happening. And then also it can sometimes be because they think they're masking the purchase and sale of security as a donation to a foundation. And again, if it walks like a duck and quacks like a duck, it's a security. Intermediaries. So this is a really interesting one. I've been talking to a lot of ICO advisory companies, and these companies, will help find investors for you, and they will help market your deal, and they'll help you draft your white paper, all for 5% of the total amount of proceeds raised. Well, that is transaction-based compensation, and that is something that requires you to be a broker-dealer or, have an investment advisor at least. There are laws and regulations around advising people on the investments that they can make, taking compensation based on the amount of money that companies raise. And so I just, it was really funny because I was talking to this guy and he's like, oh yes, we definitely think these are securities. We advise all of our clients that these are securities when we take their 5% for selling their securities. And so I was like, oh, so you guys are a broker-dealer? Oh no, what is that? Why would we need to do that? And I'm like, okay, good. Well, I'm glad you at least think they're securities. And then, of course, the giant elephant in the room is the secondary markets, right? So this is why people are actually doing these ICOs. I mean, it's great to raise all of this money initially, but you're doing that because these people think they're buying a liquid investment. They think they're buying something that is fungible, that they can go out and, at some point generate a profit, and they're not going to be stuck in this what would otherwise just be a private company investment for some unknowable period of time. And the issue with secondary markets is it's huge, and it just has to do with first of all, is this a security? Is this a commodity? Again, we're just playing the name game. And also, who are the buyers and sellers? And it's one thing to have a secondary market where you're, again, doing some sort of matchmaking between accredited investors. People, that's been done. We've seen that. But when you're trying to create some kind of ubiquitous market for all of these different types of tokens amongst unaccredited people, there are just a host of regulations that are involved. And I think a few people have touched on them today, but I think that's, I've kind of always said this, if that is the golden egg, right? If you can figure that out, I think that's where there's just an insane amount of money to be made. Okay, so that's my contact information. But what I would like to do, and Sydney, I don't know what would be better. Maybe we let Woody speak, and then we can because I'd really love to talk to you guys and, just go through some questions or hypos or whatever. Oh.
Thank you, Georgia. Great.
Thank you, guys. I appreciate it.
All right, give me 2 seconds, everyone. Wait. Okay. Thank you, Sydney, and everyone for having me here. My name is Sherwood Neese. It's great to be here. This is fascinating for me, by the way, to listen to what's going on in this whole ICO blockchain space, because it reminds me of what was going on in our heads when we came to Washington, D.C. with this idea to help startups and small businesses raise money online. Before we came here, we actually took this idea and we talked to lawyers. I'm not a lawyer, by the way, good news. And I got their opinion as to whether or not this is a good idea. And everyone said, you've got to be crazy. There's no way we think this is a good idea to let the average retail investor come into this space without some sort of understanding about what they're getting into. And I think there's a lesson to be taken away from what we did that this whole ICO blockchain industry could probably learn. And so we listened to what they said, which is, there's a fear out there of the unknown of retail investors coming in and investing in startups and small businesses that are really in their own communities, in their backyards. So how do we overcome that fear? And we said, well, why don't we just take what's happening in this current securities laws and figure out what's not working and come up with a framework that we can apply to raising money online that Washington's familiar with. So we weren't showing up in Washington with this idea of, here's something totally crazy. We showed up and we started a dialogue with them saying, this is the way companies raise money. This is the way the securities laws currently allow them to raise money. By the way, they're a little old. They're 80 years old. So we came up with this idea, and this is vetted, and we talked to lawyers, and we talked to a bunch of different people, and we want to get your feedback on it. And we're willing to negotiate and talk about how we can change this. And we built bipartisan support by doing that as we walked the halls of Congress. So we didn't try and come here and shove something down Washington, D.C.'s throat. We came here with a framework, and I think what I'm missing, and I was happy to hear that Vince is working on something like this, is a framework for how this industry can work. Because I think when you explain to people the framework under which this whole transaction will take place, and I understand there's a lot of brilliant people in this room that know how the technology works and how it benefits people. What I'm saying is, what are you selling Washington? When we came here, we didn't sell Washington on the fact that this is access to capital. This was a great way, we thought, for startups and small businesses to raise money. But that's not what Washington was buying. Washington was buying job creation, and that's what we sold them. We sold them, this is a great way for you to promote economic prosperity, create businesses locally, get the local community engaged, and all you have to do is update these security laws. That mindset, I think, is what needs to be brought to the ICO and the blockchain type of industry to help move this conversation forward. And I think if you do that, you're going to be changing it for them, because the benefit to you is you get the blockchain industry up and running, and then all this other great stuff that you can do with the blockchain and ICOs happen as default of it. But what is it that you're selling to Washington that they're buying? Is it AML? Is Washington worried about terrorists getting money? Like, where are their minds? Take where their minds are today. Focus that discussion about what you want to sell them and sell them that. So we sold them that. And then we started this, this entire regulation crowdfunding industry. Now, one of the things that I constantly said to Washington when we came here is, if we get this right, if we get this up and running, not only do we get access to capital, you get jobs, but hey, SEC, guess what you get? For the first time in history, you get transparency into the private capital markets that you've never had before, because there's a digital footprint, as Georgia was talking about, to everything that's happening. I'm an entrepreneur. I raised money for a company that was on the Inc. 500 list 3 years in a row. We did 3 rounds of financing. We raised millions of dollars. The company was actually based here in D.C. Everything that I did was behind closed doors. Nobody knew what was going on. The SEC didn't know, the investors knew, I gave them updates, but there was no real transparency on a regular basis. I actually did annual reporting to the investors, which they loved. But now that we have this mandated type of disclosure that takes place when you raise money online, as Georgia was telling you, when you do updates, when you do any amendments, all of this can be recorded. And so we built a database called CClear, which namesake, thank you, Georgia, which stands for Collect, Clean, Aggregate, and Report, because that's what we're doing. We're collecting all the data, we're cleaning it, we're aggregating it, we're reporting on what's happening in the industry. We can do this now because all of these companies are raising money online. because they're raising money online, we can actually see what are the industries that are getting funded. Where do investors have an appetite for what's going on? We can learn a ton about what's going on with averages. Like if I'm a company and I want to raise money, which industries raise the most capital on average? And so this presentation is meant to sort of quickly dive into all this. I think we can go into more discussion later on. But I just want to give you an overall glimpse of what we can see now that this industry has been about 18 months old. The reporting that I'm going to show you is up through October 31st. We take out all the information from any company that's withdrawn their offering. We only report on companies that are raising money on these portals that are registered with the SEC. And the portals have to be active as well. One of the things that we realized early on is, again, let's not recreate or reinvent the wheel. Let's just take stuff that's out there already that the market is already using and apply that to what we're currently doing. So we classify every single company that's raising money online according to Morningstar's Global Equity Classification. It allows us to actually have a great conversation with Wall Street. Because they can see what's happening in the private capital markets, compare it to what's going on in the public capital markets, and see if there's any trends or what's happening that is of interest to them. And so the other thing that we focus on in this presentation is I realize there's a lot of companies that raise money online, particularly in regulation crowdfunding. I think we're about to hit the exceed the 600 company, but I only really want to cover the companies that were successful. I really want to learn from who's successful, so did they hit their funding target and did they close? And we look at the data from two different points of view. There's the macro level, so what's happening in these sectors, and then there's the detailed level. And so with the macro level, we can see trends about where capital is flowing, and in the detail level, we can do our analysis as where investors have an appetite. So these are some of the key findings that we found. There is actually a match between issuers who are seeking capital and investors that have a risk appetite, particularly with those businesses that are most sensitive to economic shifts. So what does this mean? Well, when we look at the data and we see what's going on with the companies that are getting funded, it means that, wow, lo and behold, as we said, regulation crowdfunding is actually doing what it said, which is filling the funding void, okay? This is not the whole Bitcoin thing where companies are raising hundreds of millions or billions of dollars. These are companies that are raising serious capital that they need to fill this funding void so they can get to the next level, prove what they need to do with, I think someone in the hedge community was saying, show me what you can do with a little bit amount of money and then I'll give you a little more later on to do something else with. There's a match between products that have consumer appeal and crowdfunding. So what this is really how do you turn your customers into investors? And it's unique in the sense that you couldn't do this before. My company that I had before, we flavored medicines for children so they're more compliant. Every time a mother got her son or daughter to take their medicine, the next phone call was to me saying, how do I become an investor in your company? Well, you couldn't because we weren't allowed to raise money from anyone that wasn't an accredited investor. But imagine if I could have turned all those parents into investors. Not only would they be out there telling everyone else about the product or service that got their kid to take the medicine, but they would be doing marketing. It would just work in our favor. So what we're seeing in the initial data that's coming out of this is exactly what's happening with regulation crowdfunding. Businesses are going to their customers, they're turning them into their investors, they have a vested interest in the success of the business, and it's leading to a better bottom line for those companies. What you see are these application software, restaurants, alcoholic and non-alcoholic beverage businesses leading in deals and dollars, but there really is a broad use of regulation crowdfunding across all industries. So what does that mean? It means that it's not just one industry that's appealing. Many people, many companies are realizing the benefit of this, and they're using regulation crowdfunding as the initial way to go out and get capital. The macro level data tells us where issuers can raise money, and the micro level data, because it's broken down, there's about 148 individual industries that Morningstar covers. You can imagine we're going to have more traction and more time before we can show any significant trends from that. So I'm going to just move really quickly because I know we have limited time and all that. But if we're looking at where the companies have been successful with this, are they immune to economic shifts? And so Morningstar breaks it down by cyclical, sensitive, and defensive. Cyclical type of industries are those that are impacted by economic shifts. So they expand in good times and they shrink in downturns. Sensitive are industries which ebb and flow with the overall economy, but not severely so. And defensive industries are relatively immune to economic impact. Customers will always need these services. So when you're looking at this tree map here, I think it's really fascinating to see that this cyclical part right up here, companies that are impacted by economic shifts are raising the most money and they have the most offerings. So there's a few things that this says. This says that these are probably companies that your VCs might not invest in because you need to see a little more history or traction that's going on with them. But the crowd clearly says, you know what, I'm a customer there. I might put my money into it, okay? The second one is the industries that ebb and flow. Again, the crowd says, listen, you know, if it's seasonal, I see what's going on with it. I can be an investor in this, and they're putting their money into it too. We're not seeing so much of the defensive side, the companies that you're always going to need. Yeah, granted, it's there. We've got companies that are raising, but I think it's fascinating to see that it's the companies that are a little riskier are the ones that are going out there. Now, that might be also because the investors are not willing to put money, you know, the VCs, like I was saying, into these companies quite yet. So that's the macro level. What I tried to do in here is show you, if you break it down by quarter, what it means that's going on. Don't spend too much time looking at Q4 here, other than to let you know that this is 1 month's worth of data. So this is just from October. So we've got November and December still that's going to stack onto this. The cyclical is the blue. So these are the riskiest companies. They're closing the most offerings and raising the most money over time. You can see how it's generally increasing. Sensitive is red. These are those companies that ebb and flow and seem to be picking up interest as well as proceeds. And defenses, this is that one part of the market that I was telling you was immune to economic impact. So they've got steady offerings per quarter and steady funding. There's a broad investor appetite, okay? We've got personal services, entertainment, restaurants, retail. All of these are susceptible to economic shifts. They're leading in deals and dollars, okay? That's the blue area right up here. The technology and business service firms that ebb and flow, they're fast followers in deals and dollars. And then we've got this segment, which is beverage, alcoholic and non-alcoholic. It's fascinating to see the number of breweries, distilleries that are out there that have a massive following. So when you look at these breweries that have Facebook fans or Twitter or LinkedIn followers, they're literally using that social media to turn them into customers, or investors, I should say. The breakaway really is your technology, your personal services. What I like about the personal services, again, these are people like your veterinary, your pet services, your gym, your yoga studios, all of these things that are not your traditional way of getting funding. It turns out to be a great way for you to go out and get capital from the crowd. And we're seeing that the capital is increasing. If you look at technology, they have had the highest percentage increase in deals and dollars over time. But if you look at your personal services, there's most companies out there that are raising capital, and they're raising the most money, as you can see at the bottom over there too. If we want to drill down, again, now into industry groups, we're looking at operational characteristics. So now we take the technology and we break it down into application software and gaming. They lead in deals and dollars, followed again by alcoholic beverages, which is less than half the deals, but almost the same amount of proceeds, which I thought was interesting. And you can see this is spreading out now. This tree is really starting to spread out, but there's broad use of regulation crowdfunding among all industries. Now I just wanted to just sort of summarize, if we were to take what was going on and look at companies that raised in $1 million in proceeds, you'd see that entertainment-related companies had the most. So people that were doing movies or theater-type productions were raising the most in terms of dollars. But those personal services, gaming in the brown, had the most number of deals. So again, it's what business are you in? What industry are you in? If you're in an industry like entertainment or software, you might be able to raise the most money, but one of these other ones, personal, there's a ton of them doing it, raising a little less money. Maybe they don't need as much. The top 17 campaigns, all of these raised over $1 million. This shows you what industries they were in. Recreational vehicles. Start Engine seems to be leading the path when it comes to this recreational vehicle industry. Again, we need to see more of what's going on to see what traction. But you can see these are all companies that have hit that $1 million maximum funding target. It's spread out. It's not focused on one specific industry. Because we collect all this data, we can see averages that are happening. So this chart shows you the average raise by industry. And you can see that these breweries, they're raising the most on average, followed by medical devices and diversified industrials. All of this information is informative to both companies that are going out there to raise capital, to investors that are thinking about investing in these businesses, and it helps shape their investment decision. This chart just shows you the same thing too, which is the number of investors in an industry. So if you are an issuer and you want to go out and raise money from the crowd, this would tell you on average how many investors you would need in order to be successful with your raise. And the last couple ones are valuations. So because we collect all this information, before when I was raising money for my company, I had a conversation about what was the right valuation for my company. Now we've got all this public data that's being collected. So now I can aggregate what's going on within the industries to see what average valuations are. And this helps investors know whether they're paying a good price, overprice, or underprice for the company that they're going to invest in. And again, because this is all reported, we can see success rates. So good news, if you're in the alcoholic beverage industry, you've got a 79% chance of getting funded. Any travel and leisure, it's 75%. Now the good news about regulation crowdfunding is the companies on average have over a 50% success rate. Now, Georgia brought up a good point that some of them are putting unrealistically low targets in there, which is true, but the average raise right now is about $300,000. So these companies are getting what we think is critical capital. We're not trying to solve problems for big businesses. We're trying to solve problems for small companies that create substantial economic output for our economy. And I think this is doing that. And now with this data, you can see what's sort of happening in terms of the success rate. So companies that want to go out and raise that money can figure out how to do that. And with that, I'm going to jump back over here.
Okay, great. Thank you so much for that data. I'm kind of, right? So I'd like to just open up the floor to see what kind of questions and what's on your mind and see how we can help. Yep.
T0, what's the implication of that, the exchange that Overstock guys had started?
So this is, I mean, there are several exchanges out there. At last count, I think it was something like 600 and something, exchanges right now. The fact that it's got, some reputable people behind it, I guess, is beneficial, but I really need to see the rubber hit the road. I mean, the devil is in the details when it comes to this. Like, what entity are they, registering with and being regulated by, and who are the counterparties on the exchange? So that's, that part remains to be seen. But I mean, somebody's going to do it. I'm very optimistic about that. I just am waiting for that moment. Do you want to?
I have no input on that whatsoever.
All right.
Any other questions?
Okay. Well, thank you very much.
Thank you.